So, good morning from Amsterdam. I'm Nick Poppelaars, co-head of logistics for Savills in Amsterdam. It's my pleasure to welcome you all to this event as we, along with Tritex Eurobox, our co-sponsor of this research, launch our first census of the European logistics market. Since the onset of the COVID-19, the logistics market had witnessed increased occupier demand. Vacancy rates have been falling and rents have been rising. This has translated into a higher demand from investors as they look to deploy capital into a sector with strong fundamentals, but of course also with the opportunity for rental growth. Over the summer, we have been conducting an industry-wide survey with the aim to establishing what some of the key issues in the industry are. With better data on the market, the whole industry is able to make better decisions, which will inform the product we build, ensuring it meets the needs of the occupier. We have had over 400 responses to our survey, and the results are very interesting. This morning, you will hear from Savills Head of European Logistics Research, Kevin Moffitt, who will give a short presentation on the market. You will then hear from Mark, from our research partner Analytica, who will present the results of our census. And finally, we have a panel of industry experts who will debate the results. Of course, you will have the opportunity to ask questions to our panelists, so please submit any questions via our online portal. Finally, many thanks to all involved in pulling the survey together. Our co-sponsor, Tritex Eurobox, our research partner, Analytica, our media partner, Real Asset Media, and to those of you on the call who completed our survey over the summer. Kevin, over to you.
Good morning. Welcome to our inaugural logistics census with Tritex, Eurobox and Analytica. I'm Kevin Moffitt. I head up European Industrial and Logistics Research for Savills. I'm going to give you a very short presentation this morning, specifically talking about the property market, what's going on in the occupational market, what's going on in the investment market, and hopefully that will help us set the scene for the results from Analytica of the census, and also the panel discussion that we'll have following the two presentations. So I'm going to dive into some data on the market, and then explain what I think is going to happen for the occupational market and the investment market. So first thing to say is that all of the indicators are looking really strong. In the occupational market, we've seen record levels of take-up in 2020, 26 million square meters. That was a new annual record. On the capital markets side, we've seen 39 billion euros invested in 2020, again setting a new record. Both of those trends have continued into 2021, and I'll talk about that in a bit more detail in a few slides' time. Now, just a little bit on the economy first. We all know what happened in 2020. All European economies contracted in terms of GDP. As restrictions have been eased, growth has returned across the continent. Now, some countries are doing better on the economic side of things than others, and really all the forecasts point to an increased level of growth into 2022 and beyond. And that's important because the higher levels of economic activity drive higher levels of warehouse demand across the continent. Now, that's really interesting because if we already have really strong and indeed record levels of take-up, where is that going to push us as economies come out of the restrictions even further and drive consumer demand for products, and where does that lead us into the occupational market? My suggestion would be even higher levels of demand as economies really get back into the swing of things. Now, this chart, if you've seen me present before, I've presented it many times. It's one of my favorites. But what it shows is that when online retail hit 11% in the UK, that's when the demand for warehouse space started to rise exponentially. That's when we saw take-up rise every single year. Now, I've been updating this chart for a number of years now. And as I've updated it, all of the countries you can see there, the flags, they've crept along the online retail growth. Some of them are now ahead of 11%. 11%, which is our tipping point. Others are yet to get there. What's really interesting is we buy data in from Forrester. Forrester provide online retail growth forecasts. This is the latest data for Western Europe. What you can see here is that by 2025, the level of online retail across Europe is going to get to 25% as an average. Now, that alone means that online retailers are going to need an additional 26.3 million square meters of warehouse space. So really, you can see how much space is going to be needed just because of this accelerated growth from the online retail sector. And that growth, was happening anyway, but it's clear to say that it's been accelerated by the pandemic situation and changing consumer behavior. Now, it's not just about online retail. We've actually done this survey in the UK for the last 4 years with Tritax Symmetry and again, Analytica. And one of the questions we asked last year was, well, are you going to reshore? Are you going to stock higher levels of inventory because of the changes in global supply chains brought on by the pandemic? And you can see there was a strong response rate. Over a quarter of respondents said that was going to happen. Now, if that does happen, that's going to drive demand for warehouse space. We indeed actually did some research last year, and we found that for every £1 billion invested in manufacturing processes, that creates a need for an additional 175,000 square feet of warehouse space. So the ripple effect we see from the manufacturing sector is quite pronounced. So we think that's going to have a bigger impact in Eastern Europe, lower rents, lower wages, a variety of reasons. But all things considered, we can see this driving demand for warehouse space as well, complementing the growth for online retailers. Now, this has all conspired to mean that I think we're going to have another record year for logistics take-up in 2021. Take-up reached 18.3 million square meters in the first half of this year, way above the long-term average. And, all things being equal, we're going to get to a record level of take-up. Now, if we look at on a per capita basis, we can see some really interesting numbers here. Countries are performing above where we'd expect them to. The Netherlands, Czech Republic, Poland, really outperforming some of the other countries in terms of a per capita basis. And that ties in with what I've been saying. Netherlands, the gateway to Europe, along with Belgium, Poland, a real strong market, occupiers wanting to go there. And we see that in the take-up stats. Now, the problem, however, is supply. Vacancy rates across Europe now have fallen to an average of 4.6%. Even in Spain, where vacancy was trending upwards, it's now fallen. Sweden, you can see there at 2.8%. Now, the problem we have is that around the same stage in the cycle, the vacancy rate in the UK was around 12%. So what this means is that we should see a prolonged period of above average rental growth. Now, I'll explain what I mean by this. We buy in rental growth forecasts from a variety of places. These are capital economics growth, rental growth figures. And at 1.8% a year across Europe for the next 5 years, we actually think these rental growth forecasts undervalue the relationship between take-up and supply. Now, if we just look at London, take that as a case study. Over the last decade, rents in London have increased by 58%. Vacancy has been close to 2%, and take-up has been growing with every year that passes. So we believe, actually, that there is no reason why rents in mainland Europe won't follow the same trajectory as they have in the UK, which is when you have low levels of vacancy and high levels of take-up, rents continue to rise. And we're beginning to see that come through now in many markets across Europe. And I believe there's little reason to suggest that won't continue to happen. Now, as we get more occupational take-up, that creates a bigger pool of product to invest in. And you can see, again, H1, 22.5 billion euros invested, a 60% increase on the 5-year average. So the investor sentiment is following the occupational sentiment and deploying capital into the sector. All of that will conspire, I think, to continue to push yields down. Yields have fallen by an average of 45 basis points now. In many markets, they're now sub 3%. For the most prime stock, we're seeing deals sub 3%. So all things being equal, the occupational market conditions are continuing to funnel capital into the logistics sector. That's driving volumes and will continue to push rents downward. So that's it from me. A very whistle-stop tour of some of the big property themes at the moment. But generally speaking, you can see how the market is positioned. Low vacancy, high demand, high investor sentiment, lots of money flowing into the sector, being deployed, which will continue to push yields downwards. So that's me. Thank you very much. I'll now hand over to Mark, who will present the results of the census, and we'll then move on to the panel discussion. Thank you very much.
Thanks. Good morning, everyone. I have a few minutes with you this morning just to go through a brief selection of the findings from our first European logistics census. So across 6 different audience groups and 400 senior professionals from across Europe took part in the research over the summer months. 1/4 of those responses came from occupiers of warehouses, and of those, around a third were sourced from retailers, 1/4 from logistics providers and parcel operators, and just under 40% from manufacturers. To put the research in context, we started by asking all our audience to tell us how the COVID pandemic had impacted their business in recent months. Respondents were polarised or split on their views about the impact of COVID, and that's a common theme we've seen across many of our research projects this year. Just over 1/2 of respondents said that business had increased during the pandemic, but almost 1 in 5 businesses have seen business levels fall. Across our audience segments, developers were the most positive, with 70% suggesting that business had increased during the pandemic, whilst 40% of asset managers and just 39% of occupiers shared that view. So what have logistics property professionals learned from the last 18 months? Well, there appears to be no single overriding lesson learned, but we are seeing supply chains shorten and companies holding more inventory as they seek to mitigate the risks of disruption. There is increased flexibility in the way we work, and of course, the sector has had to react to the accelerating growth of e-commerce. Putting our research into context of current trading conditions, over 60% of developers and over 1/2 of investors see current trading conditions as more favourable compared to the start of the year. Amongst occupiers, it seems that retailers are the more positive. But however, it isn't all positive news. On the flip side, we see that around 1/4 of asset managers and investors, plus 1/5 of occupiers, believe trading conditions have worsened over the last 6 months. Now, more specifically, we asked all of our respondents to identify the biggest challenges, excluding COVID, that are facing the logistics property sector at the current time. And it's clear to see that the lack of supply of new buildings is the main concern. On the right-hand side, we can see that developers and investors are aligned in their understanding. But for occupiers, perhaps understandably, there's a greater focus on costs and overcoming the 2 key operational challenges that are shaping supply chains in 2021. Focusing now on occupiers, it's pleasing to report very healthy demand prospects for warehouse space over the next 3 years. 90% of our respondents expect to require more or the same levels of warehouse space in that time, a figure even higher than the 89% recorded in our most recent UK census at the start of the year. Now, on the right-hand side, in the dark blue segments, we can see that it is the logistics providers leading this demand, with retailers and manufacturers demonstrating quite similar demand profiles. In terms of the size of facilities that will be in demand, we see that over 1/3 of occupiers are looking for the largest mega box distribution centres of more than 40,000 metres squared. And this scale of operation is particularly important for retailers. On the right-hand side, we can see that logistics providers and manufacturers have quite similar demand profiles in terms of the size of their footprints in particular facilities, but the larger facilities are of more interest to retailers. We asked occupiers where in Europe they expect their companies to increase, decrease, or maintain their warehouse footprints in the short term. And respondents were able to select multiple countries, all of those that were relevant to their business. As we see, France, Germany, and Spain rated as the most common countries where companies are expecting to increase their operations. We next asked occupiers what features are important to them in new building design. Cost and financial terms rated as the most important factor, as they regularly do in our UK census. but having the capability to expand the size of a facility followed closely in second place. It's great to see that sustainable and green features are increasing in importance for occupiers, ranking around halfway up the list of priorities for them. Moving on now away from occupiers, the sector's positive message continued. We saw that 81% of agents and 79% of all other property professionals expect to see rising take-up across Europe in the next 12 months. In terms of investment volumes, 80% of investors and asset managers forecast rising investment volumes. And on the right-hand side, we see that of the two, investors have the more positive outlook over asset managers. We asked investors and asset managers where they are not already active, in which countries might they be likely to invest in the near term. The established, more mature logistics markets win out, with France, Germany and the Netherlands making up the top 3 new opportunities for investors and accounting for 3 of the top 4 for asset managers. But it's also encouraging to see that this sentiment aligns quite closely with occupiers' plans for growth, as we saw earlier, and highlighted here again on the right-hand side. And lastly, just to finish off today's very brief presentation, we asked investors to rank the key criteria that impact their investment selections. Building location and covenant strength are clearly the 2 most important factors. But aligning with the sentiment shared by occupiers, it's great to see that environmental features are ranking so highly, and in this case, just a single percentage point away from taking 3rd place. So that completes my very brief introduction to our first EU census. There is much more analysis to discover and to publish, and hopefully we'll be doing that with Savills over the coming weeks. Thanks very much for your time.
Thanks very much, Nick, and also thank you to Kevin and Mark there. Really interesting to get a sense of some of the details and the data from the census. So really interesting initiative. And we've got a super panel here coming up just to discuss some of those results. Feel free to put your questions into the chat on the right-hand side. We're quite tight for time, but we'll try and deal with as many of things as we can in this, and there's a lot to get through this morning, so really interesting. We've got with us Charles Pease, Christopher Stratton, Nick Preston and Marcus Dominkiewicz. So let's just start quickly with just introductions for those. I'm sure everybody does know who everybody is, but just in case there's people who don't. Let's start with you, Nick, if we can. Just a quick introduction of yourself and the company.
Richard, thank you very much. Yes, I'm Nick Preston, fund manager of Tritax Eurobox plc. We are a listed company investing across continental Europe in large format, new, well specified, well located logistics buildings. I think that's enough.
Super, thanks very much. Christoph, coming to you.
Yes, hi, good morning. Christopher Stratton, one of the founders of Logistics Capital Partners. Started in 2015 and now active developer in the Benelux, France, Italy, Spain and the UK.
Great, thanks very much. Charles.
Yeah, my name's Charles Pease, head of real estate at GXO Logistics. Recently spun off from XPO Logistics. GXO are now the world's largest pure play contract logistics company with 900 locations globally and about 220 million square feet across the world.
Super, thanks very much, Charles. Marcus.
Yeah, morning everyone. Marcus Dominkiewicz, so I am responsible for the European Industrial and Logistics team at Savills, working across both capital markets, agency, land planning, etc.
Great, thanks very much, Marcus. And I forgot to introduce myself at the beginning, but for those who don't know, my name's Richard Betts and I'm the publisher at Real Asset Media, and welcome everybody to the RealX platform. So do use that to connect with one another after the event and also to ask questions. I'll be monitoring those during the session. Nick, maybe just starting with you. Along with Savills, Tritax Eurobox commissioned the census for the first time actually for Europe. What are the kind of standout points from you in terms of the results, I suppose?
Yeah, thank you, Richard. Yeah, well, first of all, we're delighted to be teaming up with Savills on this European census programme, and hopefully this is something that we're going to be carrying on into the foreseeable future. And I think that looking at some of the data that's been provided, there's a vast amount of really interesting statistics and output here. I think first of all, the thing that we found very gratifying was the contribution from the occupiers, and I think that really adds a lot of value to these statistics. logistics in terms of hearing directly from those who are actually using these buildings and operating businesses in this space. That their input is really valid, and I think that a lot of the output from them in terms of some of their focuses on location, size of building and that type of thing is really important, and that gives us as an investor a lot of clarity, I suppose, clarification, and helps us in terms of forming our investment strategy. This type of information is terrifically useful. And a lot of what we are hearing and seeing, and Kevin and Mark produced these very interesting presentations a moment ago, is really reinforcing what we've been seeing in the markets over the last few years. And I think that part of what this is going to help us do is really illustrate to the wider market, whether that's investors or whoever, the direction of travel here. And I think that the real sort of key point here is the sort of the long-term nature of this change. There's real structural changes in how companies are thinking about logistics. Everyone's familiar with e-commerce. You know, that's slightly old hat, even though there's an awfully long way to go. Everybody's been talking about that for a long time. But I think some of these supply chain issues that have, I suppose, been flushed out post-COVID or during COVID are issues that I think are brought to the forefront here. And we're hearing this. The point I find quite interesting is this is reinforcing what we are hearing on the ground from the tenants, the occupiers that we're working with, as well as the developers and all the other participants in the market. So I think it's really just a reinforcement of what we sort of knew what was going on, but it's really useful to have some real hard data and valuable data from really good sources. There's a very deep pool of contributors to this survey. So I think those are really the key points from our perspective. And I think that as we propose to continue this program, I think we'll be able to build up a really useful sort of series of data into the long term and help us and others with their decision-making strategies and everything else.
Yes, I think the depth of the respondents to the survey is really good because it does paint a really interesting picture there, I think. Marcus, just coming to you, I mean, Kevin's presentation painted a picture of sort of structurally low supply, rising demand, rising rents, and structural factors in the market's favour, like the growth of online retail, as Nick just mentioned there as well. You're obviously an agent in the market across Europe. So I suppose, what would your advice be to investors looking to access this logistics market?
Yeah, thanks, Richard. I mean, I think from our side, you know, today's work and everything that Kevin has been working on for the last few years just continues to build the story of growth that we're seeing in this sector. And I think that probably the biggest, most important word for anyone investing into this sector for me is conviction. You know, I think we have to believe in that structural growth story, accept that it's here to stay, think there could be outperformance. I think that seeing what's happened in the UK today, you know, 10 years after this started, and it's still seeing such high levels of growth, gives a lot of comfort for those looking at Europe now, which is a bit, you know, quite a bit further behind. I think the other big bit for me is that regularly now, and Nick and I have spoken about this, we're hearing the word bubble in logistics almost too often. And I think that's mainly from outside observers. And I accept it because any market where, you know, prices have gone the way they have through the last 2 years with such intense demand, such intense competition from investors, you can be forgiven for taking that view. I think my argument in response is that this is a long-term structural growth play. You point people towards the occupiers and what they're saying, and I'm particularly interested to hear from Charles and also Christoph from what he's hearing on that side, because I think that really starts to kind of counterbalance that argument that we're in a bubble because of weighted demand. Now, obviously, the sector's seen intense interest, and that's been played out through huge amounts of money in the markets generally, issues in other sectors, particularly offices, which is typically about 50% of the market. But I think this is a really exciting market still for people to be getting into today. I think finally, from me, before we go on to the others, is that what it does tell you is that you need to really focus on where and what you're buying. And I think you've got to look at the data, you've got to look at the statistics. I think that for the European markets in general, we can all work together more to improve that data, to improve those kind of outputs from what we're working towards. And that will help us make the most of this opportunity.
Yeah, thank you, Marcus. Charles, I just wanted to pick up with you, and feel free to pick up any of those points that Marcus raised as well. But I thought it was interesting to note that the occupiers' number one concerns revolve around the lack of supply for warehouse units, and that's across the continent. Is that experience that's sort of mirrored in your activity for GXO?
Yes, Richard. I mean, it is a concern. For GXO, it's probably not our biggest concern. I think that there is a complete dearth of warehouse space across Europe. I mean, the UK is pretty much out of big box space now, which is our main sort of sweet spot, I suppose, are units between 300 and 400,000 square feet. Typically, there's pretty much nothing left in the UK. We're seeing this right across Europe, particularly in the logistics hotspots, you know, very low, very little supply in France and Italy, and we're starting to see that in the Netherlands now. I mean, I think that really impacts a lot of our short-term contracts, you know, those sort of 3 to 5 year contracts. We're certainly moving into a build-to-suit market now. In many ways, that suits a business like GXO because we're heavily biased towards e-commerce. It represents 50% of our business. We're investing significant amounts of money in technology and e-commerce and in automation, which, you know, and those capex heavy projects are well suited to build to suit. And we're looking at, an incredible business pipeline like we've never seen before. I think there were concerns just after the lockdowns in COVID that the volumes in e-commerce and online sales wouldn't be maintained. They have just continued, to be honest. I mean, we're working with customers on projects, not just next year, but 2023, 2024, 2025. So we see, going back to what Marcus was saying, I mean, this is, we're seeing sustainable growth. And yes, I think even in the build-to-suit market, I think there will be challenges in terms of securing enough land and getting the permitting, which I think some of my developer colleagues on this panel will probably attest. It's not easy, and it requires working further upstream and becoming. But I think a lot of our customers, a lot of our retail customers, and other sort of big corporates are becoming more strategic about their supply chain needs, having been impacted during last year's pandemic.
Yeah. Sorry, go ahead. Yeah.
No, I mean, I think that's the. I think yes. I mean, we're going to see. We'll talk about rents maybe later, but ultimately, we're in an interesting point in time right now, and we are going to see short-term shortages of space. I think particularly next year it's going to become quite acute because clearly there's speculative development. We're seeing some speculative developments kicking off, and that space will be taken up pretty quickly, really. What we can see coming out of the ground, but we're looking even further ahead than that now these days. I mean, I think that the market, and I think from an occupier 3PL perspective, has changed over the last 2-3 years. It's become far. We're in a long-term view now.
Yeah, no, that's really interesting. Also, to get that the difference there between the short-term and long-term perspective, Charles. I think, Christoph, I just wanted to come to you. I mean, you're obviously a key developer of logistics facilities across Europe. Obviously, there's an indication there of an issue with pressure around the supply of new buildings. What's your sense of that? And I suppose, are there things that you can do to help alleviate some of that pressure? What's the position? What are you seeing?
I think we would love to build more, obviously, since there is all this demand and unsatisfied demand in the market. It's no longer that simple. That's probably the answer, right, to this question. Land is scarce, permitting lead times are longer. I think generally the buildings are more complicated when you look at automation or certain build-to-suit typologies, such as multi-level buildings. So I think that's just the factors that we have to deal with. There are, I think, a few ways out of this. One of them was mentioned by Charles, that is the longer lead times mean that you can work with occupiers, as we do with Charles and other people. We are working today on projects that will complete in 2023, potentially 2024, on a build-to-suit basis. So that gives you the slightly longer-term view to work on a project. I think, secondly, as the rental growth comes through, it allows us, it kind of unlocks more brownfields. Brownfields have been historically always a little bit too expensive to demolish and rebuild. As the rents go up, I think more and more of these locations kind of become unlocked and can be successfully redeveloped. I think that's one way. And then the third way is to just get more square meters on the same plot of land, or more cubic meters if you want, which effectively means that we will go vertical, as happened previously or has happened all the time in landlocked places like Japan or Korea or Hong Kong. And we're effectively seeing that. So it's going to be a mix of all of those things. One of the key fundamental points is to get the authorities and the general public opinion again on board in terms of the need and the use for logistics, which means in order to get the zoning and the permitting to come through more in a more kind of efficient and normal way. And it will require from developers to be much more creative on the green features of buildings, on how to fit them into the landscape, how to fit them into the general fabric of the cities. So there's a very much, I think, lots of challenges, lots of opportunities, I think, very exciting times for the sector as a whole.
Yeah, that's interesting, Christoph. And you mentioned there the sustainability side of it. And Nick, maybe coming to you, I thought it was interesting to see in the sort of the data there that the occupier ranking of ESG and sustainability felt, to me anyway, quite surprisingly low, given how high it seems to rank with investors at the moment. I mean, did that surprise you? And I guess from sort of the kind of Tritax Eurobox position, what steps are you taking in relation to the ESG agenda, I suppose?
Yeah, thank you, Richard. Yes, it did surprise me a little bit, to be honest, that the whole sustainability piece, it wasn't slightly higher, because it does conflict to a degree with what we're actually seeing on the ground, and we're working with our occupiers almost in virtually every case to improve the ESG credentials, whether it's the biodiversity, the improving the staff well-being on site, or whether it's just straightforward energy efficiency savings and that type of thing. And so we're seeing this all the time, and so it was a bit of a surprise that wasn't slightly higher up the pecking order, if you like, in terms of concerns. But it in some ways it doesn't surprise me, because I know that we all know that occupiers, that operational business is at first, forefront of their minds. But it is climbing up the agenda. We do know that. We are seeing it as an investor from every angle. You would have seen we issued our first bond, which was a green bond, earlier this year, which was extremely well received by the market. And I think that the green nature of that from the debt capital markets, from the bond side of things, was very well received. We're getting more and more questions from our equity investors about ESG and how we're dealing with that, and you will see in our annual reports that we issue to the markets that there's more and more focus on this area, and it's something that we have to accommodate. We have to keep ahead of the game on this. It is something that isn't going away. It is not going to change, as well as the sort of moral obligation to do it from a sort of long-term perspective. It's also something that everybody is focusing on, and so I have no doubt that when we look at these surveys in the years to come, that sustainability piece will it'll always be there as a key focus and a key key concern for occupiers as well as for investors and developers and everybody else. And the other thing to bear in mind is that the regulations, and Christoph touched on this about permitting and all this type of thing earlier on, that the obligations being placed on construction is becoming ever greener, if you want to use that word. So it's coming from every angle. It's not going away. We are very, very focused on it as a business. We see it as being an essential future proofing of our portfolio to ensure that the properties that we invest in remain fit for purpose for the very long term. And it's also, not only just from this whole sort of regulatory obligation point of view, but from an occupier's perspective, we're seeing this energy efficiency. It means real cost savings to them, and so there's a real financial benefit as well as as adhering to the ESG credentials that everybody needs. So it is coming back to the original point. Yes, it was a little bit of a surprise it wasn't further up the pecking order, but I think it's always going to be there, and it will continue to grow in importance.
Okay, great. And Christoph, Charles, Marcus, if you've got a perspective on that, do feel free to jump in.
I think there is one thing there in that I think maybe historically the occupier has always been the one paying for the ESG or the upgraded specs, or through the rent indirectly maybe. While cost of operation is obviously a key occupier concern, I think maybe there are also certain occupiers that have a much bigger weight in the general market because they're just bigger, certain large online retailers, and that might just be one respondent, but could have a much bigger impact in the total market in terms of the buildings they occupy. But mostly, I think the time is there where also investors and developers are going to chip in and start paying a little bit for these ESG upgrades. The investors, because they have their green bonds, which is fundamentally cheaper capital, so some of that can flow through. And the developers, because we will need to do this in order to convince the authorities and the neighborhoods that we have the greenest possible project, which is what's going to be needed to get our zoning. So I think as more and more, as all three parties in this mix start contributing a little bit and chipping in, you'll see this thing accelerating right now. But for me, it was kind of half a surprise. And then I thought, well, the occupiers are always the ones paying for it. So I kind of see why they have to kind of watch their own budgets as well a little bit.
Yeah, no, that's interesting. Charles, did you have a perspective on that at all?
Yeah, I mean, I would say that ESG is very high on the GXO agenda. I think it's incredibly important from an environmental perspective. But again, going back to the perception of our industry, logistics, I think it's something we need to do. I mean, we have very large footprints, and so it's something we can incorporate into our buildings. But it's becoming increasingly important in the permitting process in order to get those permits with municipalities and planners around Europe. I think it's incredibly important from a perception point of view because one of our biggest challenges actually is labour, and attracting and retaining labour is something that's important to the millennial generation. It's something that's very important to our customers. A lot of our customers, it depends on the customer, but it's high on their agenda, and so we need to do something about it. But I think from an image perspective as well, in terms of and being creating warehouses that are a place where people actually want to come and work.
Okay, great. There's a question that's come in here from Linda Labby. Thank you, Linda, for that. From an investor point of view, is ESG criteria ultimately seen as a challenge or a barrier in terms of initial investment, or as a competitive asset, a positive thing? How is the profitability of taking this position measured, monitored? Do you see it as I mean, from the sounds of it, Nick, you very much see that as a positive asset, that sustainability piece?
Yeah, absolutely. As I said, Richard, we have a very focused ESG sort of take on agenda. It says when we buy assets, we carry out a full audit from an ESG perspective of the building. And that's not to say we won't buy a building that has got a low ESG score, if you like. It means that we have to come up with a strategy in the medium term to address that. And it can well be that we're buying older buildings that are properly located and all the rest of it, that we can improve and work and achieve it that way. So it is something that, yes, of course, if it's built to the optimum ESG standards on day one, great, but that's not a barrier from investment. But we have a very clear business plan on all our assets about the ESG and how on all different facets of it as to how it will work and how we'll improve it.
Great. And Marcus, just coming to you, feel free to pick up on that point around the sustainability side. But I also wanted to drill down a little bit into some of the details of the occupier survey, because it highlighted some of the key markets like France, Germany and Spain, where demand is set to rise. But there were some markets that ranked surprisingly lower. So I just wanted to also get your take on where demand is set to rise.
Yeah, sure. I mean, I think just on the ESG side, what we're seeing is it's very much investor led right now. And also, you know, for fund managers such as Tritax or investment management houses, you know, it's now a big part of their pitch to their investors. And I think that that's going to drive it forward further. The other really interesting bit for us that started to come through is this social element to ESG. You know, certain tenants now not being approved because of their social grounds. And I think that's going to be a really interesting thread that will come through over the next few years. Well, a few months probably, it'll be sooner. I think to your point on countries, I think we have to accept that no survey or census will ever be perfect. And I think we have to look at the spread of the respondents, because, you know, I think certainly Nick and Doug, who run our Dutch office, would be a bit dismayed to hear me say that there is no growth in the Netherlands. I think that naturally you are going to have different growth rates wherever you are and at any certain different point in time. You know, it's property, so it's a staccato market in a sense, but for us the growth story is overwhelmingly positive, and then there are different market characteristics, and that's how you kind of have to drill into it. You know, I spent the formative part of my career in retail, where for 5 years I don't think I ever put anything in the rental growth column of the cash flow. Now it's just deciding what number it should be, and it's kind of, is it 2, 3, 4, 5%? You know, we are increasingly going towards that 4, 5% market, and actually the Netherlands for us is probably where we're most confident right now and seeing the results through on the ground. So I think we just have to slightly kind of accept that the census is going to throw up some anomalies, but from our side, you know, we're very confident in that growth story across the piece, and then just, as I say, looking at those individual market characteristics.
Thanks, Marcus. And you mentioned rents there, and I think that's an interesting area to look at. And Charles, you also mentioned rents, and Kevin's presentation kind of showed that he expects rents to continue rising in a similar fashion to how they have in the UK. I suppose, Charles, what's your take on that? And I suppose what issue or issues does that cause for, you know, for occupiers like GXO?
Yeah, well, we see rents rising. That's inevitable. They're rising already in the UK, and usually there's a bit of a delay before that starts, spreading across Europe. I think rent increases are less of an issue with new startup projects. If you're doing a build to suit where it's effectively a new project, and you can incorporate that into the budget. I think it becomes an issue with existing leases when you get a dramatic rent increase during the course of the term, either at a rent review or sometimes at lease end. We're getting lease expiries when we're looking to renew, and there's a dramatic rent increase. You know, if it's a sort of 15% rent hike and we're seeing some pretty, you know, double-digit rental increases in the UK, that becomes an issue, not really for us, but also for the customer, because obviously they've got to incorporate that into their budgets. It impacts their profitability, and they've ultimately got to pass that on to their customers. You know, so we're dealing with a you know, a grocer, for example. You know, that basically that those increases get passed on further downstream. So I think, you know, it's obviously something we're dealing with. There are ways, of course, of softening the blow, where you're dealing with you know, not with a rent review, but with certainly with a lease renewal, but probably even easier to deal with rent increases with, you know, startup projects where, you know, you can obtain incentives and sort of amortize those, you know, rent free, for example, or other incentives to soften that. But yes, it's becoming a challenge.
Okay, great. I wanted to pick up a little bit as well, just while we're on this kind of area of different markets. And Christoph, we already mentioned a little bit about the zoning kind of side, but just picking up on that. I mean, that zoning and permitting process was singled out by occupiers across the continent, you know, as one of the key problems. Are there markets in which, I suppose, you're operating where they perform better than others in that way? You know, where potentially best practice could be applied elsewhere. What's your sense of that? I mean, are there markets where it's done in a better way, and maybe that could help, you know, other markets?
No, I think Europe is generally a mix of very different countries, and then even within those countries, you can see differences of how people go about zoning or rezoning. Paris is not the same as you would see in the south of France or the north. So I think we just have to deal with a geographically very dispersed and different market, each with its own lead times, its own rules and regulations. It's a bit hard to say that one is better than the other. That's just, you know, that's just the way it is. What we see is that obviously in those locations where land is already scarce, and especially where unemployment is low, there is much less willingness from the authorities to give up green land to logistics and basically attract diesel smoke and trucks, etc., into the surrounding villages. I mean, I think that's the very simplified doom picture that is always painted when you try to get a new logistics zone. It is a bit easier in those areas where you have more room and you have higher unemployment. So, for example, it is right now easier to develop a growing market such as Rome because there is slightly higher unemployment. There is a bit more space. Is going to be a temporary feature, but some of these markets are currently a little bit easier to unlock than others. But coming back to the thing, I think it's up to the developers and the investors and the occupiers to find their best practices and really to work with the authorities to develop greener buildings that fit better into the environment, to electrify the trucks, the vans, the cars, and find elegant solutions for traffic, and basically come with a story where increased automation is maybe not giving so many jobs, but is generating better jobs for the area. And I think that's the whole mix that we need to do, and we've got a bit of a PR job as a logistics sector or as logistics developers towards the authorities. It's a very lively debate in the Netherlands, for example, as some people on this panel will know, but the same topic is presenting itself everywhere, also in Germany. I think it's for us to reinvent a little bit our product and show its value and its importance in the overall society.
Yeah, I think that's interesting. There's a couple of questions that have just come in as well. Thank you, Brenny Obadiah, for that, and also Leah Boutelier. Both actually looking at what changes in terms of warehouse structure might be required in the next few years, according, to deal with the issues and challenges that have been highlighted. And also from Leah here, which is considering the strategic dimension of the supply chain for retailers and the rise of e-commerce, have you been seeing an evolution in the mix between the occupier-owned logistics assets versus let assets in the different types of logistics, last mile, big box warehouses? I don't know whether anybody wants to pick that up, particularly. If so, feel free to. If not, we can always try and put an answer to that in the chat later. But I don't know whether there's anything, Nick or Marcus, on the structural kind of elements of what you're seeing in terms of the supply.
Yeah, I mean, I can pick it up a little bit. I think there's a lot of talk, and it'd be interesting to get Charles and Christoph's view here about building up, multi-level warehousing and intensifying development. To date in Europe, I think there's only 2 true multi-story warehouses, of mixed tenants. This is, there's the multi-level Amazons and Zalandos that are being built. It's more common in Asia. And I think that to date, the reason for that has been because it's been easier, simpler, cheaper to build more standard warehousing. And so people have taken that route. I think to Christoph's point around us having to be smarter, cleverer, more lateral thought to carry on providing the amount of space that we expect is going to be required, then those pressures are going to come and we're going to be forced into looking at it more. But it enters into a whole new world of increased costs and relationships with your authorities when you start looking at going up. And I'd be interested to see if Christoph or Charles have anything to add on that in terms of their live project at the moment.
There is an interesting, funny thing with multi-level speculative development, and the thing is, it's a little bit scary. It's scary because, as you said, it's just starting to pop up, and even though we all understand the fundamental logic for it, the difference with a multi-level building is you can't really develop it in phases. You can't just do the sausage where you start with 10,000, you lease it up, you then build the next 10,000, you lease it up, because you've got the multiple levels. I can't just build the ground level and then put the second and the third level on top later on. I also can't just start on one side because I probably need a ramp to go up on the left side and I need a ramp to go down on the right side. So effectively, if I have a 10-hectare plot where I want to do or could do 150,000 square meter 3-level building, I'm kind of forced to put that 150 million plus, maybe 200 million plus investment all in the market at once. And that is, if you agree with me, that's a little bit scary for a developer or even for an investor to do, because previously we could just, build a 10,000, we could go in tranches of 10 million. So I think that is definitely one of the elements that is making developers potentially hesitate a little bit. And it also explains why when you've got a build-to-suit tenant that just says, I'm taking everything, like Amazon, just build me the 3 levels, I'm leasing it straight away. It's totally obvious. From a speculative point of view, it's a little bit more difficult, but it is going to come. It's unavoidable. And probably I think more of us are going to start doing it if there is sufficient conviction, to get back to your original point.
Yeah, I think it's more relevant to urban, last mile locations, yep. And it is inevitable. It's not ideal operationally, but we accept the fact that it's something we're going to have to do. Ramps aren't ideal. Having more columns and less natural light on the lower floors. I think outside the last mile, urban area, I think we're seeing a trend towards bigger boxes. I mean, I mentioned before our sweet spots typically being between 300 and 400,000 square feet. We've got quite a few requirements now. We're talking to customers across Europe for XXL type of, which is basically 700,000 square feet up to 1 million. We've done bigger than that. Christoph knows, with a project we did with LCP in Italy, which was 1.6 million square feet. And again, using height, because those 2 buildings we put ultimately 3 million square feet of mezzanines in 1.6 million square feet. So effectively, obviously, that's those mezzanines are used for storage, but with people working on them. So we're using height more and more to maximize cubic capacity, but we're seeing some very big box developments across Europe now, which it's all about scale and efficiency, and again labor, because labor, I'm sure everybody not only on this panel but in the audience will have been reading about lorry driver shortages, but we've got tremendous workforce. We've got shortages of all sorts of skilled people, not just in the UK, particularly in the UK at the moment, but across Europe. And I think by having bigger developments in the right location, or by clustering space, we can manage that more easily. And you have to remember, it's a very seasonal business. It depends which sector you're in, but obviously, we have the big peak at the end of the year, the last quarter, with Black Friday and Christmas, and we're having to bring in huge numbers of temporary workers to support. Even though we're automating all the time, we still need people.
Great. We're coming into the last 5 minutes shortly, so I wanted to pick up on a couple of things. Nick, just in terms of the investment side, obviously the market has become much more competitive. I guess investment volumes continuing to rise, new entrants also entering the market all the time, and yields continuing to fall. So does that mean you've had to adjust strategies, or I suppose what strategies do you have in place to continue to be able to source product, but specifically for your fund?
Yeah, I mean, you're right, Richard. It's certainly challenging, and it's not getting any easier. We're in a reasonably fortunate position that we have got very good contacts, relationships across Europe with companies such as LCP, where we can join forces, and effectively one of the ways of achieving this is by entering into the life cycle of a property earlier, rather than just buying a completed fully leased building, and there are advantages to doing that in terms of securing it for everybody's perspective. And so yes, we are looking at more creative ways of doing things, and teaming up with occupiers and that type of thing. As I said, it's all trying to avoid the sort of open market competition, which is frankly in no one's interest, except the brokers, of course. Sorry, Marcus. But no, we are looking at this. We're in a fortunate position whereby we have a large stable portfolio now, and that means that we can in certain calculated ways move up the risk curve a little bit, and we're looking at land plays and taking more of a development position in certain key markets. And so there are ways around it. We are achieving our goals in terms of being able to deploy equity that we raise rapidly. But as you say, it's ever more challenging. But fundamentally, the market is with us in terms of the occupier market from our perspective as a long-term investor, and that we have confidence in that. And so we believe that we are well set for the future to achieve all of our investment targets, which is fundamentally what it's all about. So yes.
Great. Marcus, I just wanted to pick up with you just one thing, which is obviously almost every indicator shown in the presentation from Kevin and Mark was a positive one, particularly for investors and developers. But in terms of the risk side of that, just briefly, are there things that you see that could maybe dampen the enthusiasm? Are there particular challenges that you're seeing?
I think within the sector, then I think we've covered it pretty well today. We're aware of the opportunity, and I think we've covered the challenges. In terms of risks, I think for the first time, industrial and logistics people are probably having to pay a little bit more attention to global economic policy. Entry pricing has got to levels now where it is predicated on such cheap availability of finance, and it is, at the threshold, I think, for a lot of investors in terms of where they need to be as a minimum for real estate as a whole. So I think that rising interest rates definitely would have an impact. Now, for what it's worth, it's quite clear to me that, the governments around the world are determined to spend their way out of this crisis rather than anything else. So I think that probably should give us some comfort for the next few years. But yes, I think that we now have to increasingly look at the sector in the context of everything else that's going on, because it's now a much bigger part of real estate. You know, it was a minnow several years ago, but that's good. That's us growing up and becoming more sophisticated.
That's excellent. That's something I'm going to attempt to do, Marcus, over the next year, is grow up and be more sophisticated. Just a last question to everybody on this, because I'm conscious of trying to finish on time. I mean, this was the first logistics census, and there was a mention there of, which I think would be very encouraging, for it to be an annual kind of census and really build on some of the data there, and maybe be able to look at how that develops over time. So difficult question, but what issue do you think the census will be flagging up in 5 years' time? Maybe let's start slightly unfairly with you, Charles.
Well, yeah, I don't have my crystal ball here with me today. I think the world's going to be a very different place in 5 years' time. I mean, I think, look, we're going to be pretty much all electric, fossil fuels out. I think the vast majority of our warehouses are going to be fully automated. We're already using robots and cobots and a lot of technology. I think we were talking about ESG earlier. I do think that could polarize the market. Obviously investors are keen on it, but I think we're going to see two types of buildings. Buildings that meet our ESG requirements and that we can invest technology and automation into, and the older style properties that were maybe built, I think buildings that were built just like cars, they could become obsolete very quickly. And I mean, I think to Christoph's point, I think that's going to tip the balance on redeveloping brownfield sites. I think we're going to be faced in a situation in 4 or 5 years where nobody's going to give us any green belt land. Ultimately, we're going to have to, develop all our warehouse space within the sort of existing logistics zoned areas, or industrial former industrial areas. So I think that's going to become ultimately, a sort of challenge where we almost have a sort of 2-tier or even a sort of 3-tier market, really.
Okay, great. Christoph, what's your kind of bet for 5 years' time?
I think 5 years is not that long, knowing that we're currently planning buildings to be completed in 2 or 3 years. So in a way, my bet is that the census might actually deliver pretty much the same conclusions: shortage of supply, risk of rising rents, increasing demand. I don't think this is going to go away in the next 5 years. And then all the ESG and the technology and the robotics will all still be there. So maybe that's a boring answer, but I think at the same time, it's a very exciting answer for the sector. This is not just a temporary pop. We've got 5, maybe 10 years more to work through this current demand situation.
Okay, great. Marcus, over to you. What's your 5 years? And I'm going to just introduce briefly a question that I've just spotted from Paul Valentinovitz, coming in quite just under the wire here, which is about, do you see similar development in cold storage, frozen warehousing, because there's been significant growth in the US in that area. So maybe that's something for 5 years' time. Marcus, who knows? What's your bet for 5 years?
Yeah, and look, that sets it perfectly, because I was going to say, I think we'll be saying similar messages, but we're all going to be talking a lot more about subsectors. I think we will see specialisms and real trends appear, and cold storage is exactly one of those. I think my stat pre-COVID was that online groceries was 3% of the market, and so as that comes through and immediate deliveries of groceries, etc., we're going to need a hell of a lot more cold storage. And to that kind of person's point, in the US, this is far more established. It's a far more kind of traded, transparent market. In Europe, it's kind of been dominated by old industrial families. That is already changing. There's quite a lot of private equity activity at an operator level, and we will see it really come through. But yeah, I mean, to round up, my theories around kind of specialist subsectors.
Excellent, that's great. I can feel that we should be starting cold storage monthly almost immediately as preparation. Nick, finally, last words to you.
Yeah, thank you, Richard. I agree with what the guys have said previously, and particularly Christoph. I think that I think there won't be a huge amount of change over the next 3, 4, 5 years in terms of what concerns people. I think that the market is likely to ever tighten. I think that the land supply point about that you made about a real restriction on greenfield. I mean, we're starting to see this now in Belgium, as Christoph knows, where there's a real clampdown coming. This will spread across Europe. It's all going to be about repurposing brownfield sites. The cost will go up, as Christoph said. That's going to impact on rents and total cost. So from an investor perspective, we're going to keep our eye on all of that type of thing. I appreciate Mark's point about specialist subsectors. And again, I think as an investor, we've got to be really quite careful about that, is that we're not becoming too specialised. Part of what we want from an investment is something that is sustainable, not in an ESG perspective, but in a long-term ability for a building to generate income for investors, and growing income for investors. And so having things that are too specialised don't always work from that perspective. But so there's a wide range of things, but I think that overall the whole logistics market across Europe is set very fair. The points that Charles was making earlier about how what we see happening in the UK flowing across Europe is very valid and pertinent, and I sense that will be a big play. That these are impacts, and we know how it all works. It comes from the US, comes to the UK, spreads across Europe, and I think that that is really just this sort of wave of change, if you want to call it that, or development will be the case. So I think that's all really. Thank you.
Great, thanks very much, Nick. Thank you, Nick, for the introduction as well from Amsterdam. Thank you, Kevin and Mark, for the presentation. Really interesting data. Really interesting to see that coming through as well, because that's the first time I've seen that kind of census, particularly for the European markets. So really interesting to see that. Thank you, Charles, Christoph, Marcus and Nick. Really interesting discussion. And thank you also for your questions. You can continue the conversation afterwards. You can connect with one another, do video calls across the platform. So feel free to do that. Feel free to visit the virtual exhibition, all of those good things. But from me and the panel, thanks very much for joining us.